January 2026 was not the moment the global financial order collapsed. It was the moment the world realized how fragile it already was. For a few hours, an unconfirmed claim moved faster than facts. No evidence, no official confirmation, no proof, and yet markets reacted as if a line had been crossed. Oil surged, governments panicked, central banks recalculated, not because something was proven to have happened, but because it felt possible. What does it mean when a rumor alone can shake the dollar system? What does it reveal when fear, not force, moves market? Time 0.5s. And what happens once the world believes that leaving the dollar is no longer an economic decision, but a dangerous one? For decades, Venezuela was not an outsider to the global financial system. It was embedded at the core of it. This was a country with the largest proven oil reserves on the planet, more than Saudi Arabia, more than Canada, more than Russia, Iran, or Iraq. 303 billion barrels of oil sitting underground, valued at over $24 trillion at prevailing prices, an amount comparable to the entire United States stock market. For most of the late 20th century, that oil flowed seamlessly into the petrodollar system. Venezuelan crude was shipped to refineries along the United States Gulf Coast. It was paid for in United States dollars. Those dollars recycled back into the United States economy through imports, treasury bonds, and weapons purchases. This was not an anomaly. This was the textbook function of the petrodollar. Venezuela was not just another exporter. It was a founding member of the Organization of the Petroleum Exporting Countries. When Venezuela spoke on oil policy, the market listened. When Venezuela adjusted production, prices moved. For 70 years, the relationship worked, until it didn't. The break did not begin with sanctions. It did not begin with financial war. It began with a political question. In 1999, Hugo Chavez was elected president. He was not a Western-trained technocrat. He was a former military officer running on economic nationalism and anti-imperialism. He looked at Venezuela's oil wealth and asked something few leaders had dared to ask publicly. Why should the most valuable resource in the country be sold exclusively in a foreign currency? Why should oil revenues circulate through another nation's banking system before returning home? And why should monetary dependence be treated as a law of nature, rather than a choice? At first, the challenge was subtle. Time 0.5s. Then it became structural. Chavez began asserting state control over oil production. Foreign companies were told to accept minority ownership or leave. Long-standing arrangements were dismantled. Barter agreements replaced dollar payments. Oil was exchanged for infrastructure, machinery, and food, bypassing currency entirely. China entered the picture. Long-term loans were issued. Oil shipments became repayment. No dollars changed hands. By the late 2000s, Venezuela was no longer quietly participating in the petrodollar system. It was openly questioning it. At the United Nations, Chavez spoke about alternatives, new regional currencies, new trade blocs, new alliances outside the dollar sphere. From the perspective of the United States, this was not theoretical. It was a precedent. If a major oil producer could begin pricing energy outside the dollar, others could follow. If that behavior spread, the foundation of dollar dominance would weaken. The response unfolded in stages. First, political pressure. Then, covert interference. Then, economic isolation. Attempts to remove Chavez through internal political mechanisms failed. He retained public support. When he died in 2013, his successor, Nicolas Maduro, continued the same trajectory. The escalation intensified. Sanctions followed. Then comprehensive financial exclusion. By the late 2010s, Venezuela was effectively expelled from the dollar-based global economy. Oil exports were blocked. Assets were frozen. Shipping and insurance were cut off. The intention was clear. If Venezuela could not access the dollar system, its economy would collapse. Public pressure would rise. The government would fall. That outcome never materialized. The economy was devastated. Hyperinflation took hold. Living standards collapsed. But oil kept moving. Not to the United States. To China. To India. To anyone willing to transact without dollars. What was supposed to be a warning became a demonstration. Venezuela did not collapse into irrelevance. It adapted. And the world noticed. What followed was not sympathy. It was calculation. Other countries did not look at Venezuela and see chaos alone. They saw proof. They saw a nation severed from the dollar system by force, yet still able to sell oil, still able to trade, still able to function outside the framework it had been told was unavoidable. The cost was severe, but survival was possible. That lesson mattered. For years, sanctions had been framed as discipline, as temporary punishment, as pressure designed to change behavior. But Venezuela revealed something else. Sanctions were not corrective tool. Time, 0.5s. They were expulsion mechanisms. If a country could be cut off from dollar clearing, from insurance, from shipping, from global banking, then participation in the system was not voluntary. It was conditional. And conditions can change. Russia understood this first. When hundreds of billions of dollars in reserves were frozen after 2022, the message was unmistakable. Reserves held in dollars were not reserves. They were permissions. Oil sales shifted. Currencies diversified. Trade bypassed the dollar wherever possible. Iran had already learned the lesson decades earlier. India observed quietly. China watched closely. By the mid-2020s, something had changed beneath the surface of global trade. Oil was still flowing, but less of it was priced in dollars. Barter agreements expanded. Local currency settlements increased. Bilateral deals replaced multilateral norms. This was not ideology. It was risk management. If access to the dollar could be revoked overnight, then dependence on it was no longer a strength. It was exposure. By 2025, Venezuela was selling the majority of its oil outside the dollar system. China paid in yuan. India paid in rupees. Russia traded goods. No conversion. No clearing through New York. No vulnerability to seizure. What had been forced upon Venezuela became a blueprint. And then, in January 2026, the rumor appeared. It did not arrive with evidence. It arrived with plausibility. The claim was simple. United States Special Forces had captured the president of Venezuela. No footage, no confirmation, no denial strong enough to dismiss it. But the reaction was immediate. Oil. Prices surged. Gold jumped. Currencies convulsed. Governments responded before facts could settle. Emergency statements were issued. Press conferences were called. Diplomatic channels lit up. Because whether the claim was true did not matter. What mattered was that everyone believed it could be. For the first time, a threshold had been crossed in the collective imagination. The enforcement of the dollar was no longer confined to sanctions, asset freezes, or legal pressure. It now included the possibility of direct force. That belief altered behavior instantly. Traders bought oil. Central banks reassessed reserves. Foreign ministries recalculated exposure. In markets, perception is action, and action creates reality. For 72 hours, the world operated as if a new rule had been revealed, that leaving the dollar system was no longer a financial decision. It was a security risk, and once that belief took hold, it could not be reversed. The market reaction was not cautious. It was violent. Oil futures surged within minutes of the claim circulating through financial terminals. Electronic trading pushed prices sharply higher, not because supply had changed, but because risk had been repriced. A new premium appeared overnight. Geopolitical enforcement risk. Gold followed. Capital moved toward anything perceived as outside the reach of coercion. The dollar initially strengthened, the reflexive response to perceived United States power. Then it reversed. That reversal mattered. In previous crises, American force projection had reinforced dollar dominance. This time, traders saw something different. A system strong enough to stand on its own does not need to threaten. It does not need enforcement. The moment force becomes visible, confidence erodes. Emerging market currencies absorbed the shock first. Those most dependent on dollar financing fell hardest, not because their fundamentals changed in hours, but because their vulnerability had been exposed. Governments reacted before confirmation arrived. Latin American leaders issued statements defending sovereignty. Diplomatic requests for clarification were sent to Washington. China convened an unscheduled press briefing. Russia demanded an emergency session at the United Nations Security Council. These were not symbolic gestures. They were signals. If the United States was willing to militarily intervene to enforce dollar dominance, then the risk profile of holding dollars had fundamentally changed. For decades, the petrodollar had been described as an arrangement, a mutually beneficial system, oil for security, energy for stability. In January 2026, that narrative fractured. The rumor did not introduce a new policy. It exposed an assumption that had always existed beneath the surface. Time 0.5s, that the system was not voluntary. The ambiguity of official responses intensified the effect. Carefully worded statements neither confirmed nor denied. Referrals passed between departments. Silence where clarity was expected. In intelligence and markets, ambiguity amplifies fear. It allows the most severe interpretation to dominate. By the time Venezuelan state media released footage of the president days later, the damage was already done. The question of what actually happened was irrelevant. The system had been tested, and it had failed the confidence check. For 72 hours. Market. Time 0.3s, governments, and institutions behaved as if the line between economic enforcement and military action had been crossed. That behavior produced real consequences. Prices moved, capital flowed, policy timelines accelerated. The incident became a catalyst not because it was proven, but because it was believed. And belief, once embedded in market behavior, does not require confirmation to persist. This was no longer about Venezuela. It was about what Venezuela represented. A demonstration that dollar dominance was not maintained by trust alone. It was backed by the threat of exclusion. And now, potentially, by force. That realization forced a reassessment across the global system. And the response came faster than anyone expected. The response was not coordinated in public. It was coordinated in private. Within days, finance ministries and central banks began accelerating plans that had previously moved at diplomatic speed. Diversification was no longer theoretical. It was urgent. Reserve compositions were reviewed. Exposure limits were reassessed. Bilateral trade mechanisms that had been stalled for years were reopened. What had been discussed quietly became actionable. Countries that had already experienced dollar pressure moved first. Russia expanded non-dollar energy settlements. Iran formalized currency-based oil trade with Asia. China positioned itself as an alternative settlement hub. Others followed. This was not ideological alignment. It was defensive behavior. If access to the dollar system could be threatened through coercion, then reliance on that system was a liability. Reducing that liability became policy. Oil exporters took note most of all. Energy pricing had always been the anchor of dollar demand. If that anchor shifted, everything downstream would move with it. Negotiations that had dragged on for years were suddenly concluded in weeks. Payment mechanisms were finalized. Currency swap lines were activated. Trade agreements were rewritten to remove dollar settlement requirements. The shift was measurable. A growing share of global oil trade began clearing in currencies other than the dollar. Not all at once, but enough to matter. Each transaction reduced marginal dollar demand. Each contract set a precedent. Each adjustment made reversal more difficult. Financial markets reflected the change. The dollar weakened not in a crash, but in a trend. Bond yields rose as foreign demand softened. Gold held gains as confidence fractured. This was not panic. It was repricing. A system built on trust was being re-evaluated under a new assumption. Time 0.5s. That enforcement risk had replaced voluntary participation. As dollar demand declined, import costs rose. Inflation pressures increased. Policy flexibility narrowed. Central banks faced a dilemma. Defend the currency or defend growth. Raise rates or absorb inflation. None of these choices were new. What was new was the speed at which they arrived. The petrodollar had not collapsed. It was bleeding. And the source of the bleeding was not economics alone. It was perception. Once the world accepted that dollar dominance was maintained through coercive mechanisms, behavior changed, permanently. No treaty could undo that realization. No statement could reverse it. The incident had done its work. It had revealed the system's true nature. And systems exposed in this way do not recover their former authority. They transition. What followed was not an immediate end. It was a countdown. The countdown did not unfold in headlines. It unfolded in timelines. By early 2026, the shift moved from reaction to execution. What markets had priced in, governments now operationalized. Joint statements emerged calling for alternative payment systems, not framed as rebellion, but as sovereignty, not as disruption, but as stability. The language was careful. The intent was not. Energy agreements were revised. A portion of oil trade moved into non-dollar settlement. Not all at once. Enough to signal direction. That direction mattered more than scale. When the primary anchor of a system begins to loosen, participants adjust preemptively. No one waits for the final break. By mid-year, the cumulative effect became visible. A measurable share of global trade no longer required dollar intermediation. What had once been the default currency became one option, among several. This altered the mechanics of demand. Less trade required dollars. Less demand reduced pricing power. Reduced pricing power weakened confidence. The feedback loop was slow, but relentless. As the dollar declined, import costs rose. Consumer prices followed. Inflation pressures intensified despite slowing growth. This was not a typical cycle. It was a structural adjustment. Higher prices collided with higher interest rates. Debt servicing costs expanded rapidly. Fiscal flexibility narrowed. The burden shifted downward. Purchasing power eroded. Savings lost value. Fixed incomes stretched thinner each quarter. At the same time, the state faced rising obligations. Interest expense climbed. Deficits widened. Monetary expansion filled the gap. Each response fed the next consequence. International. Time, 0.3s, the system rebalanced. No single currency replaced the dollar. Instead, fragmentation emerged. Multiple settlement options. Multiple reserve assets. Multiple centers of influence. A multipolar monetary order. This was not chaos. It was transition. Those positioned early adapted. Those exposed late absorbed losses. The petrodollar did not disappear overnight. It lost its monopoly. And monopolies, once broken, do not return. The incident that began with a rumor had revealed a truth the system could no longer conceal. Dollar. Dominance depended on enforcement. Enforcement created resistance. Resistance accelerated exit. The mechanism was now visible, and visibility changed behavior everywhere. The era of unquestioned dollar primacy had ended. What followed was adjustment, not recovery. And adjustment carries a cost. The cost did not arrive all at once. It arrived in layers. As the dollar's share of global trade declined, the adjustment passed through prices first. Energy costs rose. Imported goods became more expensive. Supply chains recalibrated around currency risk rather than efficiency. Inflation persisted, even as growth slowed. This was not overheating demand. It was structural repricing. Higher prices forced tighter monetary policy. Tighter policy raised borrowing costs. Households adjusted downward. Governments adjusted upward. Debt service expanded faster than revenue. Interest expense consumed a growing share of fiscal capacity. Monetary accommodation filled the gap. Each intervention stabilized the moment while weakening the structure. International investors responded predictably. Risk premiums increased. Capital became selective. Safe assets were redefined. Trust was no longer assumed. It was priced. For decades, the dollar's role had reduced uncertainty. It had simplified trade. It had anchored contracts. It had lowered transaction costs across the system. Once that anchor weakened, friction returned. Trade slowed. Volatility increased. Planning horizons shortened. None of this required a formal declaration. No summit announced the end of the system. No treaty dissolved it. The change was behavioral. Central banks diversified quietly. Trade ministries rewrote settlement terms. Energy exporters adjusted pricing frameworks. Each decision made sense individually. Together, they restructured the system. What emerged was not collapse in the dramatic sense. It was normalization, a world where no single currency guaranteed stability, where power was distributed rather than concentrated, where enforcement created exit rather than compliance. The petrodollar had not failed because it was challenged. It failed because it revealed itself. Once participation was understood to be conditional, trust evaporated. Once trust evaporated, demand followed. The incident that began with uncertainty did not need confirmation. Its function was to expose the mechanism. And exposed mechanisms do not regain invisibility. The system had crossed its point of no return, not because it broke, but because it was seen. What followed was the final phase, not the loudest, the most consequential. As the dollar adjusted downward, the consequences concentrated where adaptation was slowest. Wage earners felt it first. Salaries denominated in dollars lagged behind rising prices. Purchasing power eroded quarter by quarter, not in a shock, but in a grind. Retirees followed. Fixed incomes adjusted imperfectly. Cost of living formulas trailed reality. What appeared stable on paper declined in practice. At the national level, policy space narrowed further. Higher rates constrained growth. Lower growth reduced tax revenue. Deficits expanded under the weight of interest expense. The state responded the only way it could. Liquidity replaced discipline. Stability replaced reform. This delayed the reckoning, but deepened it. Internationally, the transition completed itself. The dollar did not vanish. It lost exclusivity. Energy was priced across multiple currencies. Trade cleared through parallel systems. Reserves diversified by necessity, not preference. A multipolar monetary order emerged not by design, but by exhaustion. No single currency carried the burden alone. No single state enforced the system universally. The petrodollar era ended the way all enforced systems do, not with collapse, with abandonment. The moment that accelerated it was not a war, not a treaty, not a policy announcement. It was a belief. For 72 hours in January 2026, the world believed that dollar dominance could be enforced through force. That belief triggered behavior. That behavior created outcomes. Those outcomes became irreversible. Whether the incident in Venezuela was real no longer mattered. Its function had been fulfilled. The system had been revealed, and once revealed, it could not be unseen. The age of unquestioned dollar primacy closed not with resistance, but with exit. Quiet, rational, permanent. The global order adjusted accordingly.